Hello, and welcome to the latest Expert Series webinar. Today's webinar is Generating Income in a Rising Rate Environment. This is a complimentary ETF.com webinar, courtesy of BlackRock's iShares unit. I'm Ollie Ludwig, the managing editor of ETF.com. ETF.com is the world's leading authority on news and data about ETFs, and it's the company behind Inside ETFs, the world's biggest ETF conference. Joining me today is Matt Tucker. Matt is Managing Director and Head of America's iShares Fixed Income Strategy. He's a member of the strategy team within BlackRock's Fixed Income Portfolio Management team, and he leads the product strategy effort for exchange-traded funds, and as well as the platform's efforts in North and Latin American iShares units. Before we get started, I'd like everyone to know that you can ask questions at any time during the webinar in the window at the lower right of your screens. There will be a Q&A at the end, and I am also likely to ask Matt questions along the way during his presentation. Also, remember that the slides and the presentation will be available to all of you by early next week. It's been more than a year since former Federal Reserve Chairman Ben Bernanke announced the tapering of quantitative easing was about to begin. Interest rates last year almost immediately began to rise. The yields on 10-year Treasury notes ended up at 3% at the end of last year. That was almost double the 1.63% that prevailed around the time that the former chairman made his comments. But a funny thing has happened since the Fed actually began to taper its $85 billion a month of quantitative easing. Interest rates have been falling for much of this year. Benchmark yields on 10-year Treasury debt are now about 2.5%. And they're really not showing any signs of increasing very rapidly anyway. But increase they will, and that is what we're going to talk about in today's webinar. And preparations for these days have huge implications for how investors need to think more carefully about income-generating pieces of their portfolios. On the bond front, the end, when it comes, of the secular bull market in bonds that began when Ronald Reagan was president, means investors need to think about capital losses and how best to weather the shift to higher rates. It's great news that iShares is iShares. And what I mean to say is that the world's biggest ETF company has a broad range of fixed income offerings in the market that fairly represent exactly what investors should at least be thinking about owning. I'm referring to funds like AGG, the Aggregate Bond Fund, TLT, long-dated Treasury ETF. On the flip side of the yield curve, there are funds like NEAR, which is a cash equivalent type of ETF. There is two very successful and liquid corporate bond funds, LQD and HYG on the high yield front. And iShares is also rolling out variations of these two corporate bond funds, LQD and HYG, including short-dated versions. And they've even launched duration hedge versions of HYGH and LQDH. And they even have floating rate funds like FLOT. I'm giving you the long list because iShares has a very, very large, comprehensive offering here, and it's likely that a lot of these funds will come into focus. And luckily we have Matt Tucker to talk about these funds and others. He is one of the foremost experts on fixed income from iShares. So let me hand the floor over to Matt to talk about how to think of income in a time when rates start to rise. Matt, take it away.
Hey, thanks, Ollie, and thanks, everybody, for joining us today. As Ollie mentioned, I run our fixed income strategy team here at iShares, and I spend the majority of my time out talking to clients, talking to investors like yourselves, and really talking about two things primarily. So one is, what's going on with interest rates? What's going on with the bond market? How can we as investors think about the bond market and think about opportunities and building investment solutions? And then on the back of that, how do we think about using fixed income ETFs? You know, as much as I love to talk about fixed income ETFs, this is a market that is only about $270 billion here in the U.S., and it's really only 12 years old. So although we've been talking about it a lot for the past decade, the reality is for a lot of investors, it's still a new idea, a new concept, and they're still learning and figuring out how how do I think about this in my portfolio relative to a traditional mutual fund, relative to an individual bond? How do I think about ETFs as a source of income? So I want to really cover three things today. So first, we're going to talk about the fixed income markets, talk about what the Fed is doing and why, talk about some thoughts on interest rates and credit spreads and where they might be going. Next, I want to turn and talk about fixed income iShares solutions. Basically, what are some different strategies you can implement given this rate environment, given this credit environment? How can you build fixed income portfolios? And then third is really how to think about just kind of putting the pieces together. So if the second piece is about individual funds and individual parts of the market, how can I think about as an investor putting those pieces together to customize my portfolio? And how can I think about positioning my portfolio depending upon the environment and depending upon opportunities that I perceive in the market? So with that as a start here, why don't we go ahead and kind of turn to the first section, talk about the Fed, and talk about what's going on. So the first slide I'm going to show you here has three lines on it. And the three lines basically show you the dark blue, show you what we call here the mean of monetary policy rules. Think of this as being basically the output from an academic model like a Taylor rule model. There's also a Taylor rule 2 model. There's some other models out there that basically look at the level of growth and inflation and where the economy is and say, given where we are in the economic cycle, this is the level of the Fed funds rate, basically where the Federal Reserve should set short-term interest rates given how we're growing. And so what you can see here in that dark blue line is basically, again, kind of an academic extraction of where Fed funds rates should be through time, starting in December 14 and going forward. Now, down below that, you have two other very interesting lines. So you have the light green. This is the light green of actually what the FOMC is saying they are going to set the Fed funds rate at points in the future. So for folks who have listened to Chairman Yellen in her comments, for folks who have read the minutes from the FOMC meetings, what the Fed is doing now is they are giving us information about what each and every member of the FOMC thinks about where rates are right now and where they're going to be in the future. So, for example, you can see in there all 16 participants in the FOMC meeting and what each one thinks about the level of the Fed funds rate that they expect will be in place in December 2014, in December 2015, even out to 2016. And what that light green line shows you is the average, or actually it's the median in this case, of those different 16 observations. So it's kind of the middle or the close to the consensus of where we expect all the different participants in the FOMC meeting where they are indicating that they believe that Fed funds will be. And really, it's probably the best forward indicator we have of the timing and pace of potential increases in the Fed funds rate. Now, interestingly, I think for the market where we are today is that bottom line, which is the dark green. This is the pricing of futures, and these are Fed funds futures that list and trade on the exchange in the market. So this is essentially the market's pricing of where they expect the Fed funds rate to be at different points in time. So for example, if we look forward there in 2015, you can see that the market is pricing a level, and this works out to be about 75 basis points of Fed funds rate. So basically the Fed funds rate being about 75 basis points above where it is today. Now, if you look at the FOMC minutes and look at where all the governors and other participants are indicating will be, it's actually a little north of 1%. So you've got this gap between what the FOMC says they're going to be doing versus what the market actually thinks they're going to be doing. And this, for me, is kind of the crux of the challenge where we are right now. The market essentially does not believe that the Fed is going to be as aggressive as they say they're going to be in raising short-term rates, or the market is skeptical that we're going to achieve the levels of growth and inflation that the Fed expects, because in the end, it's that data, it's the growth and inflation in the market that is ultimately going to drive the actions of the Fed and drive them to push up short-term rates. Now, if we think about how this impacts the rest of the curve, if we look out across interest rates broadly, what we show here are two Treasury curves. The light green is the U.S. Treasury curve today as it stands, and the dark blue shows you the Treasury curve 1 year from now, June 2015. And one of the very nice things that I love about the fixed income markets and about rates is that there's a lot of math here, and you can basically look at where yields are today, and you can actually see what the market has priced in about where yields are going to be in the future. So all we've done here is basically said, based upon where yields are today, the market is pricing in that in 1 year, we'll see yields that are higher than where they are today, but actually not significantly higher. In fact, if you take a look at this, the market expects that even a year from now, in the summer of 2015, the 10-year Treasury is still going to remain below 3%. This is the market's expectations. And again, I think when looking at expectations here, just like looking at the Fed funds futures we looked at a minute ago, it's a great way to get a sense of where people are putting their money. So there's a lot of sentiment, a lot of things out there. At the end of the day, how are people investing their money? What is the consensus in terms of what the market expects for the level of rates? So if you kind of look at the market and where we're going here, the expectation is that we will see higher rates, but it's not drastically higher. And in fact, if you roll this forward and were to look at where does the market expect the 10-year Treasury to be 3 years from now? So we're talking about, the middle of 2017, it's about 3.25%. And so this is something I just want to reemphasize to people. We talk about rates rising. There's a lot of concern about rising rates, and a lot of investors are positioning for it. But it's important to put that into context and to remember that we're probably going to be talking about rising rates for a couple years. And so rates will be increasing, but even the way the market has priced it in, 3 years from now, we're still at a 3.25 10-year, which I think by most standards, at least by historical standards, is a fairly modest level of risk and a level of yield really for a 10-year Treasury. Now, if you think about what's driving this, so what's driving the Fed actions, what's driving this fairly modest expectation about an increase in interest rates, there's really two things I would encourage people to think about. So the first is inflation. And what we're showing here are two different measures of inflation. The light green is the CPI. This is the Consumer Price Index. And the second in the dark blue is the break-even inflation rate. This is basically the level of inflation priced into markets through TIPS, Treasury Inflation Protected Securities. So by looking at TIPS securities, you can actually see what the market believes inflation will be in the future. And in this case, we've plotted it against what realized inflation has been to the CPI. And what you can see here is that they're both running right around 2%. The CPI that just came out earlier in the week was at 2.1% year over year. Break-even inflation is running about those levels. So you're really not seeing a very significant level of inflation either realized or expected in the market through forward prices. And the way I think about inflation in terms of the Fed and Fed policy is in the presence of inflation is what's going to cause the Fed to really take action or change what they're doing right now, right? They're essentially in a position where they're keeping rates low, they're trying to encourage growth in the economy, get jobs going, get people back to work, and they'll continue to do that as long as there's no presence of inflation, because essentially inflation is essentially the cost that they will have to pay at some point in the cycle for putting all the stimulus in the market. But without the presence of inflation, there's really no regulator. There's no reason for the Fed to slow down and to cease providing easy money to the market, because essentially they're not causing any of the negative impacts of easy money, in particular inflation, which is really the part of their focus. Their so-called, the dual mandate, as we call it, is the Fed wants to stimulate growth and also keep an eye on inflation. So that's the inflation side. What does the growth side look like? Well, you've got it here in two different ways. So on the left here, we've got GDP growth. How are we growing? The economy in the U.S. broadly, and then what's happening with unemployment. And you can see in the left there that although we are seeing positive GDP growth, it's still fairly modest. We're not seeing the 3-4% levels that you tend to see in a recovery. So although we're starting to see growth, we're back to positive, it's still not at a level that starts to concern the Fed. There's still not a concern that we're overheating from an economic perspective. And if you look at unemployment there on the right, we can see that although the unemployment rate has come down pretty significantly, we're running about 6% now. We're still at a level that the Fed feels like we can still push that down lower, and the presence of easy money will help to keep unemployment contracting. All right, so if we now take a look here on the credit side of the equation, so given that low rates, On the credit side, what you see here are two lines here, and these are the OAS, or the additional spread. OAS stands for option adjusted spread, and think of it as the additional yield that you are paid as an investor for investing in either investment grade, which is the blue line, or in the high yield market, which is the orange line. And what you can see is that level of additional spread has steadily contracted from the end of 2008. I'm going to pause there. I think there might be someone on the phone who's got their phone. If you just put it on mute, please, that'd be helpful. Thank you. So if you take a look at these spreads, they both started to contract way at the end of 2008, which is when the Fed instituted their zero interest rate policy. And really from that point, you've seen spreads come in. In investment grade space, you see they've come in now to levels just about 100 basis points, and in high yield levels about 337 basis points. So what does it really mean for investors? Well, it means that we've been in a very favorable market for a number of years for corporate issuers. Rates have been low, money's been cheap, it's been a good environment for them to refinance. Economic growth, although it has not been gangbusters, has been steadily positive. And we're also in an environment where, because yields are low, a lot of investors are reaching for yield, trying to add yield to their portfolio, and you've had this constant bid for investments that provide income. And that's what's helped push these spreads tighter as investors have been moving into these markets. So you can see here, if you look at the high yield number at 337, we're still above levels that we saw, during 2004 to 2006. So we're not near historic tights by any means, but we're definitely at the narrower end of the range. And so an investor today who buys high yield is paid much less in terms of spread, or in terms of additional income, than they were paid just a couple of years ago. So the kind of the balance of risk and reward has shifted. If you look at the investment grade side, you can see that you're getting paid about 100 basis points, in this case 99 additional basis points of yield, or about 1% of yield for investing in investment grade. Again, that's not as low as it was back in that 2004 to 2006 period, but it's still a fairly low level. And the flip side of this, and I think what a lot of investors focus on, is that it's not just about spread, it's about the total yield that you receive. So given that Treasury rates are so low, when you add on these additional spreads from credit, the overall coupons and yields you're getting from corporate bonds today are near historic lows, almost no matter how you look at it. For most high-yield indices, we're running between 5 and 6% of yield. That's a very low level compared to what investors are used to getting paid for investing in the high-yield market. Now, another way to think about the same challenge of what am I getting paid for what I'm investing in, look at the following graph. So what this basically shows you is how much risk you have to take to generate 5% income. And we're measuring risk here as realized risk, so ex post risk. So after you're looking back at returns, how much have those returns moved around, and basically how much fluctuation in value has there been. That's our risk measure. And that green line shows you how much risk you would have had to take throughout history to get a 5% income. And a lot of investors think about 5% income as being a very attractive number to think about from an income, fixing with an income solution. So if you look at that, what you can see is that today you have to take about almost 7.7% risk to get 5% of income. And if you go back a couple of years, 2007, for the same 5% yield, you had to take about a third that much risk. And in fact, if you roll back even farther, back to periods when interest rates were much higher, when the Fed funds rate was much higher, you get 5% or close to it from a risk-free investment. And so this is the real challenge that investors have today, is that they have to take a lot more risk in their portfolio to generate income. And I think this is, for me, is the challenge of the low interest rate environment. So given all that, let's now kind of turn and talk about strategies and to talk about what investors can do in this market, some ways to think about managing interest rate risk, ways to think about opportunities in the market, and ways to position a portfolio. So another way first I want to start by talking about how to think about these two major components of risk, which is interest rate risk and credit risk. And what you see here are two graphs. On the left, what it shows you is how much interest rate risk, how much yield you get for different levels of interest rate risk just for buying U.S. Treasuries. So think of Treasuries as the investment that gives you income in terms of yield and you're taking on just duration risk because there's no credit risk, there's no default risk inherent there. And you can see that even if you go and you buy, a more than 20-year Treasury, even if you buy a 30-year Treasury security, you can't get to a 5% yield level. And so really the story here, and this is sobering news, but I think old news for a lot of people, is that there is no way to reach that magic 5% yield target by investing just in Treasury securities or just in risk-free securities. I mean, the 10-year Treasury today is paying about a 3.3%. So in order to get to a higher level of income, and what a lot of investors have been doing is moving to the right, which is basically looking at ways they can add credit risk to their portfolio. And unfortunately, the story here is actually not that different, in that if you look at buying corporate bonds today and look at the yields that corporate bonds offer, all investment-grade bonds and the majority of below investment-grade or high-yield bonds still offer yields below 5%. So I think for most investors in that market, they have to think about different ways to get income. I think they have to think about the trade-offs. And I think one conclusion for a lot of people is that a 5% income number probably isn't going to be achievable without taking on a great deal of risk. And I think that's a very important message for people to understand, is that although it seems like 5% is a fairly modest target, for most investors, no matter what your target is, you probably have to adjust to a lower expectation of yield and return given where yields are and given what the opportunities are in the market. Now, if you think about the composition of the risk in the market, so think about that investment grade number, and you think about the two major pieces of risk, credit risk and interest rate risk, one thing you can do in this market is think about, well, how comfortable am I taking interest rate risk? How comfortable am I taking credit risk? And how can I think about different combinations of those in my investments? And so we show you, for illustrative purposes here, three different stack graphs here. The first on the left shows you a broad fund, and we can use like an LQD, which is an investment-grade corporate bond fund as an example. And you can see it has a composition of interest rate risk and credit risk. If I'm looking to reduce my rate risk, one way I can do that is buying a shorter duration or shorter maturity portfolio. I'll use in this case SLQD, which is a 0 to 5 year version of that same LQD fund. And what you'll see there is that I get less risk, both in terms of rate risk and credit risk. I'm going to get paid less yield for that because I'm taking less risk, but I can maintain a balance of rate risk and credit risk if that's my objective. The other option, actually Ollie made reference to this at the top, is that I can actually go and invest only in credit risk or only in rate risk. And so, for example, there's a fund here, LQDH, which is comprised of, what the fund actually holds, it holds the LQD fund plus a Treasury futures position to remove rate risk. And so what you get then is just the green portion, you can see there, which is just credit risk and not rate risk. And the reason I bring this up is to really point out, and we'll get to more of this in a minute when we talk about individual funds, is that investors now have a lot of flexibility through fixed income iShares of basically obtaining access to almost any part of the fixed income market, which really allows you to tailor your risk between credit risk and rate risk. Now, for the purpose of simplicity, and I'll talk about this more a little bit later, but I'm not including currency risk. We're kind of focused on the U.S. market. One challenge, and if we looked at global rates, you'd see this, is that low interest rates are a challenge for investors in all parts of the world. And if you can believe it, the rates we have here in the U.S. with treasuries are actually higher than some countries, such as Germany or Japan. But this search for yield is a global challenge. And so if you think about this in an international context, when we talk about going into high yield, the analog outside the U.S. would be going into, say, emerging markets. And, of course, the other risk you could add if you go non-U.S. would be currency risk. And so there can be ways to get higher yields, but you're going to end up faced with the same types of risk trade-offs, which is what kind of risks am I comfortable taking on in my portfolio to obtain yield and to build yield in my portfolio. So what we have here are a couple different strategies. Think of these as different ways we see investors positioning their portfolio in this market. And I want to walk through them at a high level and then talk through a little bit more in each of these in more detail. So one is short maturity strategies, which I'll touch more on. And this has been a very popular trade for investors concerned about rising rates. They still want to obtain income, but they want to position their portfolio in a way that's going to be less impacted by rising rates. The next is floating rate securities. Again, I think it's in a very similar vein, those investors who are worried about rising rates, who want a coupon or yield, which is going to ratchet up as rates rise. interest rate hedge products, which I mentioned, for those investors who want to take on just credit risk or who just want to control the composition of rate risk in their portfolio. They can use those for that. In the bottom left, high yield funds. So for those investors who are comfortable investing in high yield securities, who want to add more risk, can use a high yield product. And then lastly, the bottom right, I'll talk about IYLD, which is a multi-asset income, which is a portfolio that actually combines a lot of these different strategies into one to provide a diversified income solution. I'll touch more on how that's constructed and how that's put together. So rolling forward, short maturity. By and large, this has been a dominant driver in terms of flows in the fixed income ETF market over the last couple of years. If you look at the bottom right, we've actually broken this out. The green line shows you flows into short maturity ETFs, and this is across the U.S. market. And the blue line shows you flows, in this case, out of longer maturity ETFs. And you can see that the story really in 2013 was that everyone moved to short duration. A lot of money came into short maturity ETFs as well as mutual funds and other products, and money came out of longer duration or more rate-sensitive funds. And you can see on the left graph there kind of why people did this. If you were traditionally in a position, we're using AGG as the example, so a kind of a core bond fund, and you want to reduce interest rate risk, you could move down to the left, reduce your duration or rate risk, invest in something like a near fund, which is a short maturity fund, or a CSJ. You're getting it less yield for that, but you're also going to remove your interest rate risk. And I bring up these two funds because these are two ways we've seen people kind of actually execute this trade. CSJ, that's a 1 to 3 year credit fund, so it's investing in credit or corporate bonds primarily, which have a maturity between 1 and 3 years. These are shorter maturity, but because it's credit, you're still getting some yield for that investment. And the other fund here, near, is a short maturity ETF. So think of it more like a multi-sector fund within fixed income. It'll invest in corporate bonds, government, securitized assets, really looking to achieve a diversified cross-section of fixed income exposure that's going to provide income, and it's going to maintain a duration inside 1 year, which is going to limit the amount of rate risk that it has, which you can see reflected there on the graph. So for investors who are looking at that, one of the real reasons they moved towards this strategy was really how these strategies might perform in a rising rate environment. And as a case study here, I'll show you what happened to the 1 to 3 year credit index the last time the Fed was in the market raising short-term rates. So if you kind of go back to 2004 to 2006, this is the last time the Fed was actively raising short rates, and what we saw is that for 17 consecutive meetings, they raised the Fed funds rate by 25 basis points. So it's a long, steady increase in rates, which some people expect might look similar to what we might experience going forward. And in that market, what you can see is that we did see, rates rise. You saw a price decline, kind of a price impact to all fixed income. And in this case, we're showing you in the blue there what the price return impact was to the 1 to 3 year credit part of the market. And you can see that as rates rose and prices fall, because that's how bonds work, it lost 2.69%. But the flip side of this is that because it's a fund, and because that fund is continuously having securities roll out, it's reinvesting at higher yields, the income steadily increased over the period. And in fact, if you look at the total return there in orange, the fund still had a positive total return of just over 2%, even during a period where rates were rising. And so this is one of the reasons people have looked to short-term rates, especially those who are concerned about a near-term move by the Fed. Those rates, the rates are increasing, the additional income is helping to offset that, and actually in the last credit cycle produce positive returns for this 1 to 3 year credit index. Now, another way to think about, short-term investing in a rising rate environment is through floating rate notes. And there's two versions, primarily floating rate notes that investors look at. They're investment grade floating rate notes, which is the FLOT fund, which I'll talk about here. The other way to access this market is through what they call levered loans or bank loans. Those are also floating rate securities, but they're essentially high yield from high yield issuers or below investment grade issuers. FLOT, which I'll focus on here, is investment grade only. And the securities that make up FLOT that are held in the fund primarily reset off of a short-term rate, in this case 3-month LIBOR. And what that means is that, and you can see this in the chart here, as you see the Fed funds rate increasing, and that's that orange function, this is kind of that step function I mentioned where the Fed raised rates in 17 consecutive meetings, what you see is that 3-month LIBOR, which is a floating rate, and that's that green line, increases. And then moving right along with it on that purple line is the average coupon of floating rate notes. And so this is the reason that some investors like this type of instrument or like this type of asset class in a rising rate environment, because the coupons will reset according to changes in short-term rates, which provide an income lift even during a period where rates are rising. So to turn now to high yield, we've seen a lot of interest in the high yield sector, and I think that's really because a lot of investors are looking for yield. It's one of the few places left where you can get a significant or kind of an above average level of yield in this market. It's not without its risks, obviously. These are high yield issuers. These are below investment grade or the more risky issuers in the market. But in an environment where Fed continues to make money cheap and available, where economic conditions on average improve, corporations, for the most part, have been in very good position, and realized default rates have remained low. And so we've seen investors who are willing to take on this high-yield risk and seek this high-yield yield because economic conditions generally are favorable for high-yield issuers in the current environment. And there's kind of two important things to point out here. So one is in the bottom right there, the yield and duration. You can see that high yield on average, although it has some duration, is typically less than broad funds like an aggregate a fund which is investment grade. And you can see we're highlighting two different flavors of high yield here, HYG, which is the whole high yield curve, and then SHYG, which is a 0 to 5 year or short maturity high yield. And we've seen some investors who've been favoring short maturity high yield if they like the yield of high yield but are concerned about rising rates. It's a way to get into that asset class with less rate sensitivity. I think important to kind of think about for high yield on the left here, these are correlations with other asset classes. So this is a 10-year period ending in the middle of this year in June. And you can see that high yield historically over this period has had a correlation which is a little negative to treasuries, but tends to be higher to stocks, EM, other risky asset classes, as high yield does have a risk component to it. And so in a risk-off environment where investors are generally exiting riskier asset classes like stocks, high yield will tend to move more with those high-risk markets than it will with something like treasuries, which tends to be more of a beneficiary in a risk-off environment. So that's an important thing to think about when you think about high yield and how you put it into a portfolio. So one of the things is interest-rate-hedged ETFs. And this is something that's a newer product, a newer kind of investment opportunity for people that I think is worth spending a couple minutes on. So if you look in the table here on the middle of the light blue, the middle of the right-hand side of the page, we're showing here is a table that shows you LQD, which is an investment-grade corporate bond fund, and LQDH next to it, which is an investment-grade corporate bond fund with an interest rate hedge. And what you'll notice is the durations or rate sensitivities of the two are very different. It's close to 8 years for LQD, and it's actually just over 0.1 years for LQDH. But they have almost the same level of credit spread. This is an important feature. So an investment in either one of these funds maintains exposure or gives you exposure in a consistent way to the investment-grade corporate bond market, but they have very different levels of interest rate sensitivity. And what that means is that an investor can, using these two as endpoints, achieve an investment-grade corporate bond exposure at almost any level of duration they want. And so in this case, we show an example of how someone would combine the two funds. You can put them together. You can get a duration of about half that, about 4.72 years, but you maintain the credit spread of the IG market, the investment-grade market. The same thing can be done in the high-yield space. There in that dark blue table on the bottom right, you can see HYG. Again, this is a broad high-yield fund. It's a duration of just under 3.5. There's about a 310 basis points or 3.1% of additional yield you get in that fund over above treasuries. HYGH, which is the interest rate hedged version of that fund, which is next to it, has almost zero duration again because the interest rate risk is hedged out of the fund, but it maintains their credit spread exposure. And so just doing a simple combination of the two, you can get to almost any level of rate risk you want while maintaining high yield exposure. And I think that this is the type of solution I think we'll see a lot more applications for as investors get more savvy about thinking about rate risk and thinking about how to adjust their portfolio. And what it really allows people to do is to separate the decisions around rate risk and credit risk. So you as an investor can look at the market and say, I actually want to go and invest in a given spread market, like say high yield, but I can now control the amount of interest rate risk I have with that high yield investment. It really gives you much greater control over how to think about where you invest your money and how you invest it. Last thing I'll touch on here in terms of funds is multi-asset income. And this fund and this concept was really born out of this idea that clients had. Clients came to us and said, we see all these different pieces you've given us in terms of different ways to access the high yield market and the investment grade market and the treasury market. And they really just said, what are some sensible ways to put these together? What are some sensible ways to build portfolios that help me achieve a certain outcome by using these individual iShares as the building blocks? And so IYLD was designed to be a multi-asset income portfolio. And so you can see a breakdown here. If you look at that pie chart, you can see it's got a broad cross-section across fixed income. It's actually 60% fixed income, 20% equities, and 20% alternative sources, primarily REITs. And what you can see on the left here, the actual allocation across individual funds. So it does have high yield exposure. It has treasury exposure because that treasury is a nice diversifier against some of the stocks in the fund. It's got long credit. It's got individual dividend stock funds like HDV. It also has some non-U.S. exposure into things like international REITs. And so this, I think, is a good example of a way that, you could combine individual iShares to, in this case, create an income solution. We actually run this fund versus a Morningstar index, and that index is optimized to basically achieve the highest level of yield while maintaining a risk level that's close to kind of a broad market risk. And so it's kind of achieving this nice combination of looking for risk-adjusted returns. And, investors can think about ways they can combine this on their own. So to kind of get into that more, and I think this is actually, for a lot of people, kind of where this whole conversation leads is, great, multi-asset income or IYLD is one way I can buy an off-the-shelf product, but what if I have investment needs that are different? What about my customized investment needs? How can I think about using ETFs and using your fixed income iShares to build those? So if you take a look at what we have here, is we show a pie chart here of these different combinations of funds. And what I'm trying to illustrate here is this idea that if you have almost any investment view or any adjustment you want to make to a portfolio, you can go and you can adjust duration, you can adjust credit, you can adjust your non-U.S. exposure. And what it does is really two things. And the first thing it does, what I think is really important for people, is it lets you customize exposure according to your needs, or if you're a financial advisor, your client's needs. So, for example, you can adjust duration. If you have an investor who has money that they want to have more stability, that might be more sensitive to changes in rates or changes in markets, you can actually adjust the duration of the portfolio, invest in shorter duration or shorter maturity, less interest rate investments, like an SHY, which is 1 of 3 treasuries, or the FLOT fund, which is floating rate notes we talked about later. But by the same token, you can have investors who might say, I'm actually comfortable with rate risk in this environment. I'm willing to take on more rate risk to generate yield. And so they might buy something like a 20-plus treasury, TLT, or even 10-plus credit through CLY. By the same token, you can customize exposure by credit risk. We talked about this in terms of the interest-rate-hedged funds like LQD and LQDH. You can also look at adjusting credit exposure by credit quality. So there are individual funds that give you exposure to just A or better corporate bonds like QLTA, to just what we call the crossover, which is basically lower investment grade and higher quality high yield. That's QLTB. Or you have a fund that invests in actually the low credit quality segment of the high yield market through QLTC. So that ability to customize and say, I'm willing to take a certain level of rate risk or a certain level of credit risk, and I can buy that very precisely to customize an exposure. And of course, international, and we touched on this a bit earlier, but you can invest in sovereigns, either across developed markets. You can invest in emerging market sovereigns. You can invest in local market debt for emerging markets, and even corporate debt coming from emerging market issuers. So a tremendous amount of flexibility that investors have to really customize exposure. And when I think about how this applies, obviously for every investor, they have the ability now to go out and build a diversified fixed income portfolio with what amounts to a handful of individual tickers that you can buy and trade on the stock market. Right? So if you think about, the challenges a lot of investors have with building and maintaining bond portfolios, bonds are very difficult to access, very difficult to trade for most people. iShares, what they really do is allow you to really access the bond market like the stock market, with the same ability to actually see liquidity, see funds, execute, and at the end of the day, manage exposures much more efficiently. If you think about the amount of time and effort it takes to run a 50 bond, individual bond portfolio versus a half dozen or dozen iShares, the iShares are going to be, a half dozen or dozen essentially equity tickers, right? And so there's a great deal of ease of management and scale you get there, especially for folks who are in the wealth management or advisory community who are running multiple portfolios for multiple accounts. So it gives them really control to adjust portfolios and to customize them as needed. The second part about this, and I think this is something that is still, fairly new or is really gaining traction, is this idea that as an investor, you can now have a view on the fixed income market and can look for opportunities in that market. And one way to illustrate this is with this quilt you see on the page in front of you. And what these are returns for major fixed income asset classes, and I just picked 6 of them here. So a couple different treasury funds, investment grade corporates, high yield corporates, mortgages, inflation protected treasuries. And what we've shown here is the total returns for each asset class each year, going back to 2002. And we've also ranked them according to the total return. And so what you can see is something like high yield debt. That's in the orange. It tends to be either the top performer or the bottom performer, right? I mean, it's a higher risk investment. It's a high income investment. It tends to do well in markets where corporations are improving or income is improving, and in markets where, the economy slows down or we have a shock like we did in 2008, it does not tend to perform as well. You can contrast that almost exactly with 20-plus treasuries in the blue, the dark blue. 20-plus treasuries being long-duration treasuries, being typically a flight to quality investment. When things go wrong, people tend to buy treasuries and bid up prices. It tends to be at the opposite end of the spectrum from high yield in most markets. And the point of the whole thing is that if you're looking at, again, just at high-level major asset classes in fixed income, there are actually some pretty significant differences in return if you look along the bottom. So that bottom row there, which starts at 18.4%, and then as you move to the right, it goes to 27.2 and then 7.6. That's just the return difference between the best and worst performing asset class in fixed income. And I put it there just to remind people that even in the fixed income market, which you think of as pretty sleepy, there are actually some pretty significant return differences between fixed income asset classes. And what it opens up is an opportunity for people to think about ways to implement views. And if you look at this very simple chart in front of you, I've just kind of laid out a couple of very simplistic environments. So economic recovery, this is on the left in that view column, or economic growth declining, or reducing home country bias. Basically, you as an investor have a view on what's going to happen in the future, or in the case of the last one, you have a strategy you want to implement in your portfolio. I think most people have in their heads pretty quickly a stock solution to that. So if I believe that we're going to have economic recovery, most people would say, of course, I want to have more consumer cyclicals, more cyclical stocks, growth stocks, high beta stocks. Most people get that intuitively. They're familiar with the equity language and the equity way to think about implementing investment solutions. What people are realizing is that there is also a fixed income analog, because in that environment where the recovery is improving, you could also look at adding credit risk, high yield bonds. You might want to go into investment grade. The point is that for that equity view, there is a corresponding fixed income view. And if you look at the slow market, growth declining, again, the equity view, you want to go up in quality. You want to get more staples, less cyclicals, more dividends. In the treasury space, you're going to pull away from credit risk, probably take on more interest rate risk, buy treasuries, other high-quality investments, buy something like a GOVT, which is the broad market across govies, or an MBB, which is the mortgage market. So the point here is that for most investors, people are already implementing views, their investment views to some degree in their portfolio, and thinking about shading it according to what you expect the market to do. And most people do that in the stock part of their portfolio. And what I just want to encourage people to think about is think about the fixed income side of the portfolio. Obviously, a big role the fixed income plays is a stabilizer. So for a lot of investors, they're going to say, you know what, I want fixed income to play a certain role. I don't want to be very tactical with it. But for that part of your portfolio where you might be more tactical, or for those times when you think you have conviction about a view and you're looking to implement it in the stock part of the portfolio, think about the fixed income side as well, because whatever view you have, you can actually implement consistently across your portfolio using something like fixed income iShares to implement on the fixed income side. So with that, I'm going to end my prepared comments here and just turn it back over to Ollie for questions.
Thank you, Matt. You had so much to say. I was tempted to jump in a few times, but you were definitely on a roll. So that was very, very informative. Some of these slides are real keepers, too. So Again, I want to remind everyone that you will get this deck early next week. You'll get an email to explain how to get your eyeballs on it. Let me just ask one quick point of clarification, Matt, with regards to your outlook over rates in general. You seem to be rather, shall I say dovish? It's going to be a few years. You laid out those graphs of the median views within the central bank. Can you just review really quickly what your view is here before we get underway on some plenty of questions from the audience?
Yeah, I think it's a fair assessment, Ollie. I think I am fairly dovish in terms of my view on rates. One way I think about this is if you think about the Fed, and we showed the graph earlier that showed you where the Fed expects the Fed funds rate to be in the future. If you go out as far as they go out, so out to the 2016, they still do not expect, and this is the Fed, they don't expect that the Fed funds rate will be at what they call their terminal rate. So they don't think it's going to be at the rate where they're going to end raising rates. So even by their own estimations, they think this is going to go on for another 3 or so years. And as we saw in that graph, the market actually thinks they're going to go slower than that. So, so you're going to think about at least what priced into the markets and expectations is that we're going to be talking about the Fed raising rates for a couple years. This is going to be a long, slow, careful process. And so I expect that we will see higher interest rates, but it's going to be modest. And I would say that if I think about different parts of the curve, it's probably that short to intermediate part of the interest rate curve, which is more sensitive to rising rates as it's going to move with the Fed. Whereas for longer-term rates, unless you see a big pickup in inflation or a big pickup in growth, you're probably not going to see significant move up there. That's going to really take some time for the economy to recover and inflation and growth to really come back in the picture.
Perfect. And if something were terribly wrong with your view, what would be one of the first variables that makes you sit up and go, whoa, I got to rethink this really quickly?
That'd have to be inflation. I think that's a reflexive answer for any fixed income investor. That's the only thing you worry about. You worry about inflation taking hold very suddenly. If that were to happen, that would push up interest rates. That would push the Fed to act much more quickly. It could be a drag on growth. I think it would impact the market and the outlook in almost every conceivable way. It doesn't look like that's present, but I think that's the risk people really think about.
Got it. Now, there are quite a lot of questions dealing with different pockets of the marketplace, dealing with liquidity, accessibility of these vehicles. Obviously, all these different components of the fixed income world in an ETF wrapper is very compelling. But what if, the underlying is so illiquid that the so-called liquidity of the ETF is completely undermined? And I'm wondering if you might shed some light on, maybe we're talking about how to trade these things. Floating rate comes to mind as underlying that aren't terribly liquid. Fixed income in a general sense relative to equities isn't as liquid. So you get off in the far reaches, emerging markets and stuff like that. You could get conceivably into trouble pretty quickly, especially when you have some of the markets closed when you're trying to execute a trade here in the States, for example. Can you shed some light on some of the mechanistic elements of how to grapple with that challenge?
Yeah, I think that there are a couple of really important things for people to think about. So one is that what a fixed income ETF is it's basically a portfolio of bonds that is trading on the stock exchange. At the limit, if everyone wants to go and buy an ETF, everyone wants to go and sell an ETF, at the limit the ETF can only have as much liquidity at the limit as the underlying market. So this is a fair point where you say, well, gosh, what if everybody goes and wants to go and sell high yield? What's going to happen? Everyone goes and sells the high yield ETF. What's going to happen to it? Well, the other part of this that's important to remember is that the ETFs trade on the exchange. So take something like HYG, which is a high yield ETF that iShares offers. It lists and trades on the exchange, which means you can actually see the liquidity. It tends to trade somewhere around $300 million a day. So you can actually see that. And the liquidity, almost all the liquidity you see on the exchange is actually in addition to what the underlying market is providing. And by that I mean that on most days, for every dollar, I will do the other way around, for every $8 of, in this case, HYG that trades on exchange, only about $1 of high-yield bonds changes hands. So although HYG is dependent upon, like all ETFs, the underlying market, it's providing a level of liquidity above that. And so for a typical day where HYG might trade $320 million a day, then on average only about $40 million of bonds changes hands. And we've seen it even in stressed markets, the same relationship applies. If you go back to the taper tantrum, I think you'd mentioned opening comments, Ollie, we saw a lot of money come out of high yield at first. We had a day where over $200 million came out of HYG in a single day. But on that day, that fund traded more than $1 billion on the exchange. And so the answer to me there is, okay, yes, it definitely had to tap the underlying high yield market to $200 million of bonds had to change hands. But if you think about that, $200 million changed hands, but the ETF traded $1 billion, which meant there was an additional $800 million of liquidity available to the market. So, you can never guarantee liquidity in any market, whether it's bonds or stocks or anything, but what we've seen historically is ETFs tend to provide liquidity even in stressed markets, and they often provide increased liquidity in those markets because more people are coming to the ETF as their source of liquidity in those times of stress.
Got it. Now, there are quite a few questions here addressing dividends, which you have not really gotten into apart from IYLD, which we'll get to in a moment as well. But if you could comment on dividends as in equities, right? Stock dividends. How do you regard those in this overall mix? And there's one question very specifically, kind of a throwback question, but a genuine and a legitimate one. Why not just own ATT? 5% yield. It's dependable. What are the advantages of bond ETFs and the disadvantages of going with that simple one-stock solution with a 5% yield on it?
Yeah, what was that stock you mentioned?
ATT.
ATT. Oh, got it. For single stock. Okay, yeah. So a couple things. So to the first part of your question about income. So all of our fixed income iShares do pay monthly distribution of income. And the way to think about it is that the fund's going to pay out the earned income that is being thrown off the underlying securities. So if the underlying securities are all paying 2%, the fund will start distributing about 2% out to the market. The great thing about that is that because it's a distribution on what essentially is an equity security, you can actually go and look at dividend history and everything else like you might see. So people should expect distributions on these funds to be very close to whatever the underlying market yield is, less the management fees of the fund. And that applies, for iShares or really any ETF out in the marketplace. Particularly to IYLD, which should come up, because it is a multi-sector fund, it is a combination of both fixed income and equity iShares underlying it. All those funds do pay out income. They can be on a different schedule. So, for example, a lot of equity iShares actually pay on a quarterly schedule, whereas fixed income pays monthly. So if you look at distributions each month, what you'll tend to see is they spike every quarter. But over the long run, and I'll just cite here the 12-month yield right now in IYLD is a 5.9%. So you will tend to get a fairly steady stream of income that you have historically over longer periods, but you will see some lumpiness quarter to quarter.
There was a very specific question about IYLD about how the portfolio is constituted. How's it determined? How often are those constituents in the portfolio rebalanced?
Yeah, so IYLD, like the majority of our fixed income iShares, is running against an index. This is actually an index which is calculated and published by Morningstar. And so what they're doing is they are optimizing a combination of fixed income and equity funds to achieve the highest level of yield possible, for a given level of risk. So basically, what's the most risk-efficient portfolio to achieve yield? So that's going to be rebalanced, in the fund on a monthly basis. Holdings are going to be published out to the market, so you can actually look. If you want to go to the iShares.com website, you can actually see the individual funds held by IYLD. So what it's really doing is just rebalancing according to changes in market conditions to maintain this, hopefully, yield-efficient portfolio per unit of risk the fund is taking. And last thing, I'll just touch on the question about, why not just go and buy an individual stock? I think this comes back to, a lot of very basic things around, risk, return, and diversification. Obviously, any individual security you buy, an equity, a stock, anything, may look great for a given point in time, but we know that over longer periods of time, presents a lot of risk for the investor in terms of default risk or just changes to that security. So I'm a big advocate for diversification no matter what we're talking about, fixed income equities or anything. And you can think about this historically in terms of markets. There's been a lot of things which look great at one time, and one day you might have just said, why don't I just go buy a lot of WorldCom stock or bonds and put that in my portfolio. So things change. Diversification is the key, I think, to long-run success for investors. And so I would advocate that generally no matter what market we're talking about. Think about diversification. Think about the value. You almost always will give up something relative to what looks like the best opportunity in the market, the highest yielding bond, the highest dividend paying stock. But historically, what people have realized is that you will gain in terms of a lower level of risk and a better risk-adjusted return through long periods of time.
What do you make of business development corporations and their place in ETF portfolios? I don't believe iShares has a BDC ETF yet. Is that something that might happen, or do you have any reservations about that particular structure in an ETF wrapper?
We don't have a fund, and to be honest, I really don't have a view to share at this time.
Fair enough. Okay. The muni ETFs you have not touched on very much at this time. Can you offer some, contextualize a little bit how a muni allocation could fit into a broader approach to this challenging fixed income environment right now?
Yeah, it's a great point. We haven't touched on this. In the market, I'll give you kind of my view on munis generally is that, I think they still look pretty attractive on a risk-adjusted basis and a tax-adjusted basis, relative to other asset classes. They can be a good source of income, especially for, in a taxable account. We have a broad-based national muni fund, MUB. Its trailing 12-month yield is 2.91%. So depending on your tax bracket, that's going to get you up there in the kind of the 4 to 5% range, and that's, it looks fairly attractive compared to other investment-grade options such as investment-grade corporates. So I think for folks in taxable space, munis still definitely make some sense. They can be a good source of income. Again, they're like anything else. Yeah, I'd advocate diversification, especially in the muni market where there's a lot of different issuers. I think diversification is really a great long-term investment, especially if you're looking over longer time periods where economic conditions can shift, and that diversification can really pay benefits and dividends.
Perfect. That just about wraps up how much time we have. Matt, maybe you want to say something really quick about how some of the attendees could get back in touch with your company. There are certainly a lot of questions here that have been posed that have not been answered, and I'd love for you guys to have an opportunity to answer them because a lot of these questions are quite good. So if you will, a contact number, email address, whatever you deem appropriate, Matt.
Yeah, sure thing. Thanks, Paul. I appreciate that. So just to put it out there, probably the best source of information around the iShares funds is the website iShares.com. We've recently put out a new version of it. I think we get a lot of great feedback. I think it's a great resource for information about funds, about dividends. We got some calculators there in terms of helping people build portfolios, look at correlations, things like that. You can always call 1-800-iShares. For questions you have. We'd love to hear from people, hear your questions, and see how we can help.
That's great. So that concludes our Expert Series webinar today, Generating Income in a Rising Rate Environment. Matt, thanks for being my guest, and I also want to thank the audience for attending and for some great questions. I would encourage you all to follow up. I would say from my personal experience as a journalist, iShares is great at answering questions when you've got loads of them. Again, this presentation will be available to all of you by early next week. There's some really great slides in this deck that I found very illuminating, and I'm sure a lot of you will as well. You'll receive instructions on how to get that deck in an email. As I said earlier, on that note, on behalf of Matt, my guest from BlackRock's iShares unit, as well as my colleagues here at ETF.com, I'm Ollie Ludwig, wishing you all a very pleasant afternoon.